Hi, welcome to Investment Analysis and Portfolio Management course. The title of this module is Bond Portfolios. The section goal is to understand the valuation of equity and bond portfolio management, and the module goal is to understand bond portfolio management. Bond valuation is the process of determining the fair price or value of a bond. Typically, this will involve calculating the bond's cash flow, or the present value of a bond's future interest payments, as well as its face value, also known as par value, which refers to the bond's value once it matures. Some terms are fixed interest coupon bonds, which its cash flows are known with certainty. Bonds are a subset of what is known as fixed income and the most common type of fixed income security. So, a bond is debt packaged as a tradable security because it needs to be repaid eventually or called principal when paid. A bond's total price represents a percentage of the bond's principal balance, otherwise known as a par value. A bond is simply a loan after all, and the principal balance or par value is the loan amount. Bond price and bond yield are inversely related. As the price of a bond goes up, the yield decreases. As the price of a bond goes down, the yield increases. This is because the coupon rate of the bond remains fixed, so the price in secondary markets often fluctuates to align with prevailing market rates. When interest rates rise, bond price fall, with long maturity bonds more sensitive to rate changes. This is because longer-term bonds have a greater duration than short-term bonds that are closer to maturity and have fewer coupons payments remaining. Next, we are going to discuss yield to maturity. The yield to maturity of a bond is the internal rate of return. A bond's yield to maturity is the internal rate of return required for the present value of all the future cash flows of the bond to equal the current bond price. YTM assumes that all coupon payments are reinvested at a yield equal to the YTM and that the bond is held to maturity. The yield to maturity of a bond is essentially the internal rate of return associated with buying that bond and holding it until its maturity date. In other words, it is the return on invested associated with buying the bond and reinvesting its coupon payments at a constant interest rate. Calculations of yield to maturity assume that all coupon payments are reinvested at the same rate as the bond's current yield and take into account the bond's current market price or par value, coupon interest rate, and term to maturity. As the interest rate rises, the YTM will increase. As interest rates fall, the YTM will decrease. Next, the important concept in bond is the duration. Bond duration is a way of measuring how much bond prices are likely to change if and when interest rates move. In more technical terms, bond duration is measurement of interest rate risk. Understanding bond duration can help investors determine how bonds fit into a broader investment portfolio. Macaulay durations equal the weighted average of the times to each coupon or principal payment. The weight of each cash flow is determined by dividing the present value of the cash flow by the price. Macaulay durations is frequently used by portfolio managers who use an immunization strategy. Next, the concept on convexity. Convexity is a measure of the curvature in the relationship between bond prices and bond yields. Convexity demonstrates how the durations of a bond changes as the interest rate change. If a bond duration increases as yield increase, the bond is said to have negative convexity. So, relationship between bond price and yield is not linear. Bonds with higher convexity exhibit higher curvature in price-yield relationship. Convexity is measured as the rate of change of the slope of the price-yield curve, expressed as a fraction of the bond price. One of type of bond is a zero coupon bond. Zero coupon bonds are bonds that do not pay interest during the life of the bonds. Instead, investors buy zero coupon bonds at a deep discount from their face value, which is the amount the investor will receive when the bond matures or comes due. Despite the volatility in the financial markets over the last 3 decades, bond portfolios have been shown to produce lower levels of both return and volatility than what was shown by other asset classes. So, there is also a strategy for bond management. Passive management take bond prices as fairly set and seek to control only the risk of their fixed income portfolio. Two classes of passive management include indexing strategy and immunization techniques. Both classes accept market prices as being correct, but differ greatly in terms of risk exposure. Indexing strategy, sometimes called passive bond investing, is a popular approach to building fixed income allocations. A bond index strategy is a portfolio of bonds that seeks to track the performance of a market index such as the Bloomberg Barclays US Aggregate Bond Index, while immunization is a risk mitigation strategy that match assets and liability durations so portfolio values are protected against interest rate changes. Finally, there are risks in investing in bonds. Interest rate risk is the potential for a bond's value to fall in the secondary market due to competition for newer bonds at more attractive rates. Changes in interest rate will move the price of the bond, so there is interest rate risk. In addition, credit risk is the risk of a bond not paying what it should. The amount of credit risk in a coupon bond is often estimated by comparing that bond's YTM to the YTM of a comparable government bonds of similar maturity. We have a quiz for this material. Ceteris paribus, the price and yield on a bond are A. Positively related, B. Negatively related, and C. Sometimes positively and sometimes negatively related, and D. Not related. So, this is the end for this module. See you later.